Hi guys, in today's lesson we're looking at the Ichimoku cloud. It's also known as the Ichimoku Kinko Hayu, that is the professional name for it, IKH. It is a Japanese term and it's used to gauge future price action. So let's take a look at what this means. It does look like it's a bit of a mess on the chart, but we're going to look at this in more detail. So the main use is for JPY pairs, so we're on the USD JPY pair at the moment on the 1 hour chart. The reason why we're using the 1 hour chart is because this indicator works well on this specific time frame. So let's take a look. So we've got a green cloud, red cloud, we've got some squiggly lines here. So let's break this all down. Okay, so the Kiju Sen is the blue line. So very faintly, I'm not sure if you can see, but the blue line is this line here. So that's the Kiju Sen. So it's also called a standard line or a baseline. And it's calculated by averaging the highest high and the highest low for the past 26 periods. So you can say it's almost like a moving average. So we'll look at this in more detail. We also have the Tikan Sen. So I'm not sure if I'm pronouncing these right, but I will go into more depth and write these down for you later at the end of the video. The Tikan Sen is the red line, so it's this red line here. So it's just under the blue line, and the Tikan Sen and the Kiju Sen are always usually together, so you can see they move in sync with each other. Now the Tikan Sen, the red line, that's also known as a turning line. How that works is it averages the highest high and the lowest low for the past 9 periods. And then you've got your Chiku span, which is your green line. Then the green line is this big long line here that moves in waves. So the green line is also known as a lagging line or lagging span. What that means is it lags behind price action, so it always follows a trend. The further away this green line is from price, it means the stronger the trend. So as you can see, the Chiku span is going closer into price here. It's almost crossing over, and that has caused price to divert in the opposite direction. So we always need to keep an eye on this line to see what price is going to do. And then you've got your clouds. So you've got your green cloud, which is going to be your Chiku span, and your orange cloud here, and that's going to be your Senku span. So what this means is when price is above the cloud, it means that there is bullish action happening in the charts. As soon as price action touches the clouds or comes into the clouds, like this area here, it just means that there's a bit of consolidation, so you don't want to be involved in this market. As price is crossing over the cloud, it's getting ready for a good entry position to the downside. So we can see here there's huge sell-offs that we could have got involved in. And we can confirm this by the lagging line was the green line, which was a Chiku span line. So this would have confirmed that this was a strong trend to get into. So an entry point of where we could have got into this trade could have been roughly around here, securing picks following downwards. So that's how we do gauge future price action, and that's how we look at this chart using this indicator. All this means is price underneath the cloud, it's a sell. So you can see there's huge bearish action. Price above the cloud is a buy, huge bullish action. As soon as price is starting to come between the clouds, it means you're not supposed to get in any of these trades, and we should wait to see what price is going to do, whether it's going to divert in the opposite direction as it has done here, and whether there's that distance between the lagging span and price action showing you the trend is strong to continue and stay in. To exit these trades, what I would do is I'd look to see where this lagging span is diverting, where it's going into price, looking like it's going to cross over. And what I would do is I'd get out of the trades to be safe, get in on another entry should that entry be another sell-off. If not, wait for price action to reverse and possibly get into the upside after prices cross the cloud. Okay, so let's break this down. So we were talking about the Ichimoku, Kinko, Haiyu, abbreviated as IKH. And let's go in detail about the depth of each line. So we have the Kiju Sen, which is the blue line. And this is also known as the baseline or standard line. And it is calculated by averaging the highest high and lowest low for the past 26 periods. Okay, following the Kiju Sen line, we have the Tenkan San, and this is going to be your red line, and this averages the highest high and the lowest low for the past 9 periods. Following the Tenkan San line, we've got the Chiku Span, which is your green line. This is the lagging line. And use this only as a guide. So we've got our 3 lines. We've got Kiju Sen blue line, Tenkan San red line, and Chiku Span green line. So that's how we use the Ichimoku cloud. And basic rule is when price is over the cloud, we want to sell. And the basic rule is when price is over the cloud, we want to buy. And price below the cloud is a sell. Okay, so that summarizes Ichimoku, Kinko, Haiyu. Hope you've enjoyed this video. Thank you. Bye.